All right, that'll do it. So the person who asked for that topic isn't here. And of course, I can already see how that was going to work out. If I go through it, they're going to show up in about an hour and say, "Oh, no, I wasn't here. Do it all again." And if I don't go through it and we wait all day, they're going to show up 20 minutes before the close and say, "Oh, no, I was just going to catch the replay." And then we didn't do it. So I'm going to go ahead and do it. And if they show up, they can watch the replay either way. So the first thing about the dividends and finding the stocks, there's a cheat code to all of this. There really is. You can do it yourself and manually scrub through all of the things out there to try to find good dividend companies, but you don't have to. They're they're popular. This has been around for a long time. There's been some really smart people that's put a lot of time and effort into it, and they've ranked dividend companies by a few different metrics. And so you can find dividend ETFs out there and dividend lists out there. So two of the most popular ones is the Dividend Kings and the Dividend Aristocrats. Now that list, it's pretty generic, really. It's just based on how long they've been running their dividend with an increase every year. You know what I mean? That's like the only metric. So obviously a company would have to be doing well to be able to hit some of their benchmarks. Think of a company that's been raising their dividends for 25 years every year, never missing a year. They must be doing pretty good. Or a company that's been raising them for 50 years must be doing pretty good. Right. So um, if you're looking for a list of stocks with a focus on dividend investing, start with those. I mean, all the work is done. Then you can just weed them out by what suits your needs, what sector or industry that they're in, how large they are, whatever your portfolio can handle. That way, you got a good list. You didn't have to work too hard for it. And it's what everybody else is focused on too, so that you're not just some lonely Joe plugging away at one company. That might not suit everybody's needs. And then when it comes to dividend investing, you really want to try to define for yourself which group you might want to be in, right? There's the ones that are looking for immediate cash and they're going to be pulling that cash out. And then there's the other ones who want to compound it into like a snowball effect. And when they get paid, they just roll it into more stock and they just keep compounding it over and over and over. So you can mix and match. You don't have to be just one or just the other, but you want to have a clear idea what your goal is before you even get started so that you're looking in the right direction, because those companies that will do really good for the immediate payout wouldn't necessarily be the ones that you might want to focus on for that long term compounding dividend growth. Just two different kinds, right? So with that in mind, there are some tools out there that can make things easier. On the screen, when I started all this, I was looking at Walmart and I've got this little label here. Yields above 3% is good. And Walmart's yields right now is not even one, right? So maybe not a great example. I should have probably found maybe something with a higher number. Cat isn't doing good either. I don't know.
Philip Morris, Altria, MO.
Yeah, cigarette companies, huh? Uh,
It's a dividend. I mean, if you're trying to illustrate a point, you
yeah,
don't have
yeah,
to recommend a
yeah.
company.
I was trying to find one above 3. So thank you. 6. I'm rounding up, but MO is at 6% yield. So I have the watch list for the Dividend Kings and for the Dividend Aristocrats. I remember when I first started trading, there was places that would sell you this list, right? Like you had to pay for it. You couldn't just get it. And at the time I thought, well, that sucks. That's the typical trading world. Nobody wants to give you a leg up. They all just want to sell you something. And now with AI, I just asked, hey, what's the current king list? And it gave it to me. And then what's the current aristocrat list, which has the kings in it, or vice versa. And it gave me that. And I was like, all right, well, now cut all of the duplicates out. And so we did that. And I got the two lists. So I can share those in the chat. That's not the notes I'm looking for.
What AI tool did you use? Was it just a Notebook LL?
I promise it won't matter. Just go to your favorite AI and ask it for the list of dividend kings and then for the list for the dividend aristocrats.
Yeah.
There's no magic to it. I promise. Whichever one you use, it should have the list.
Right. Okay. I wasn't really asking for the dividend stuff. I was going to ask you for something else, but once you're done with this, I'll ask my question.
Oh, go ahead. I got to cut and paste, so it'll be silence if you don't.
No, it's like been pulling teeth with some of the AI tools I've been using because I've been wanting it to look at or filter out stocks that don't have earnings for the next 2 weeks, like 14 days, and options, like open interest above 500 and volume above 1,000 and so forth. And it's with ChatGPT, it's been like pulling teeth getting it done. So I was just wondering if you knew either or another way of getting it. But
I would not know. I don't ask
okay.
AI those questions. So I would say you need to hunt around and try different ones to see what suit your needs.
I thought
last week, Marziti had told us about this website that has like 5 different AIs all built into it. And you ask your question and it spreads it out to all of them and then brings you back the best answer.
Oh.
And I would say if you're hunting around for something from an AI perspective of who can handle the job, or just maybe you just want the damn thing done, right? You don't care who does it. Just give me an answer. That would be a really good place to go.
Okay.
Because if none of them can do it, then you know that you're reaching too high at this point. Might need to give it another year because they are still limited, and in a lot of things they're still limited.
Okay. Marziti, would you know what's the name of the website?
I believe it was multiplechat.ai. Multiple chat, one word, .ai.
I don't know how you remember that, young man.
I signed up for a month on it. It was $20. But
oh,
you can do regular stuff. It just without paying for anything. It just cuts you off on how many chats you can have per day if you don't have a sub. And I was using it for some confirmation of some stuff, so I signed up for a month just to see.
It is easier to remember something when you're paying for it. That answers that question.
And, yeah, I mean, that's true. And the other thing about it too, though, is $20 a month has access to ChatGPT, Grok, Claude, and Gemini. What I don't know is does it use the thinking model or the fast answer model from those others? But generally, what happens is when you submit your question to multiplechat.ai, it throws the question out to all the 4 models, LMs, LLMs, whatever. And of course, they each submit a reply, and then however they do it, this is all magic behind the scenes. But then it picks one of the AIs and says, okay, this is going to be your project. These are the 4 responses. Put it together, make sense out of it. And then that AI takes all the different responses, and it may send questions back to the other AI, say follow up on this, explain this further. I don't know how many passes it makes or anything like that. But the real question to me is, can it give me a good bread recipe? Can it give me a good cookie recipe? No, I'm just kidding.
Mhm.
That's an interesting idea, though. Anyway,
So it's multiple chat.ai.
yeah.
Okay. Okay. Cool.
Yeah,
Thank you. Thank you.
I don't, when I go to AI, I haven't reached the point where I'm comfortable giving it work to do, really, like, give me a list of companies having earnings in the next week kind of thing. I'm just not there. I'm so used to doing that work myself, and I don't know, I don't remember stuff well, right? That's why I got so many notes. And when I do the legwork, I tend to remember things better. So if I do give that kind of stuff to AI, it's like in one eye out the other kind of thing. So I'm still just, I do a lot of that legwork. But on the other hand, I use AI for all sorts of things, from diagnosing car problems to, seasoning my new grill, whatever it is. So best answer I can say whenever you get stuck with AI is try another one.
Yeah.
And I suppose I'm using, or I have access to a free one because I've got a paid Twitter account. So I've got the free, or not free, but the AI that comes with it, Grok. But I haven't been using Grok. I've been using Gemini, and I don't know. I don't have like a souped up Google account. I'm not really paying some business edition Google, so I don't suppose that I have an advanced Gemini, probably the basic free version that everybody else uses, and it tends to suit my needs.
Yeah, I just started on the task of doing that. I just have like I just last night went through 174 different stocks trying to filter out what I'm looking for, and that can be very tedious. And now that people are using AI a lot, I figure maybe I could try something that'll cut down on the work. So
You do a
that's
lot of earnings related trading?
no, I don't. I want to cut out those uh, stocks that are about to give earnings. So I filter those out. The ones that have already reported and the ones that still are reporting, but 2 weeks away.
I mean, you can do that through Thinkorswim Scanner,
Yeah.
which is the way I recently did a portfolio rework, and the first thing that I did was I went into the Thinkorswim Scanner and I put in some criteria, such as minimum $5, um, minimum $1 billion market cap, $100,000, or excuse me, 100,000 shares per day minimum for the past 21 days, and then also at the same time average for the past 63 days. So that shows me consistency. And something else. Anyway, oh, and no earnings in the next however many days. And then you get that list, and then you can export that list, and then you can drop it over to AI and say, okay, let's get to work here. These companies seem to have some strength to them. They're not fly-by-nighters, or whatever your criteria is for a good, decent company. And then you can use Thinkorswim to scan it originally, and then I took that list over to the AIs and gave it the criteria what I was looking for my new portfolio, and said, okay, we talk about the nature of the portfolio, and then it says, okay, these tickers or ETFs or stocks or ETFs specialize in such and such, or whatever. So that was just one way that you can do it. You do need to include, when you export the list from Thinkorswim, category and sector information to help the AI. If you give it 200 tickers, it is not going to go research all 200 of them. You have to give it as much as you can up front. So now in my case, I also use a website called stockrover.com.
Yes. Mm-hmm.
And so I can take Thinkorswim, grab the initial list, go over to Stock Rover, and it can give me more of a spreadsheet output with a lot more detailed information that I could then toss over to AI. So, and then using, AIs back and forth and let them argue it out. And I didn't know about multiple chat at the time. I just have to go to Chat GPT and say, give me your list of this, whittle this big list down. And then I took that, I went over to Claude, and I said, this is what Chat GPT thinks. What do you think? And Claude said, well, Chat GPT is full of crap. I think it should be these. And then, and I start looking for overlaps between them and just kind of bounce it back and forth until I got down to a list that I really liked.
Okay. All right. Thank you.
There's a couple of different tools on Thinkorswim to do yields and dividends and to calculate things like the payout ratio and all of that. I just went crawling through all of my Think scripts looking for a particular one. I didn't find that I had it in the system, so I'm just going to put one together here real quick. This should calculate the dividend payout ratio. Now it's getting lost on yearly dividends. I'll have to circle back through and figure out where, probably because we're not doing the 12-month thing. So some of this we might have to do by hand. Learning how to do it is kind of the point, though. Once you know how to do it, then you're much better prepared. I need to, my copy and paste isn't pasting from the other, there it goes. That should do it. That didn't do it. That's for a particular stock. We'll circle back to that then. So to calculate the dividend payout ratio, which is one of the biggest numbers that you could use for how well the company is going to be for a dividend stock, you would use the annual dividend divided by the earnings per share. And it's basically what percentage of the company's profit is it giving away to people who hold stock. So without that, we can see we have the earnings per share. And if I was to look in the watch list, it probably has the annual dividend as a column. So we can just take those two and do our own math. There's also the yield percent, which is what we started the stream with when we're looking at Walmart and Altria. And then the dividend yield just as a number rather than as a percent. So there's a lot of ways to see how a company is doing. And then there's different formulas on whether or not you would want to use it for a payout system, or if you want to use it for a longer term kind of buy and hold, rolling the profits. Well, I don't know if you want to call them profits, rolling the payments year after year into a long-term account. The thing that I got hung up on when I was new to dividend trading and developing in a portfolio was there's all these YouTube videos and they're all just pump and dumps. They got this list. They're trying to convince everybody that you should go and hop into them. They have a high dividend payout. They pay like monthly and it sounds great. But then you go look at the stock and it's some beaten down turd. And the amount of money that you have to risk with the stock and how much the stock can lose versus how much you might possibly make from the dividend, it's just a losing battle and a losing game. It is worth mentioning that the dividend game is really for large accounts. If you've got a small account and you're looking to grow that small account, doing it with dividends is not going to get you where you want to go. The fastest way to grow an account is to turn that capital over, getting in and out of trades, looking for whatever's moving and trading that move, not sitting in accounts that are hanging on to some dividend payment, because it's just a slow road, right? So something to really think about is if you're looking for growing a small account, and especially quickly, dividends ain't your game. So every site is different on Thinkorswim. If you want to know what the dividend is on a particular product and when it pays, we'll go back to MO since that's what we were using earlier. Up at the top, we got the underlying tab. And when I open that up, I can see the dividend. It's $1.06. The frequency is quarterly. The last one paid was in March. And I have the total number of shares here. So there's the yield of 5.97. We saw that out on the chart. So this is a good place to find the information that you're looking for at a glance, is right here on the options tab. So trade all products, that's the menu at the top. The list we were talking about earlier with dividend kings and dividend aristocrats, there are qualifications to that. It's not just any stock. It's for the S&P. So let me get specific here and talk about what the criteria is for dividend aristocrats. 25 years to be considered a dividend aristocrat, a company must meet specific criteria defined by the S&P 500. It must have increased its annual dividend for at least 25 consecutive years. It must be a member of the S&P 500. And of course, that means it has to meet market capitalization and liquidity requirements. Otherwise, it wouldn't even be in the S&P 500. And somebody manages that to ensure no single sector dominates the list. Whoever that somebody is, I don't know. There are some breakdowns into that. So like technology and data, IBM is on that list. That's one that really stood out. For energy, ExxonMobil or Chevron. Healthcare, Cardinal Health. I didn't like any of the financials and insurance names, but utilities had NEE, Nextera, and Eversource. So some names that are familiar. Caterpillar's on the industrials and materials list. So is General Dynamics, Sherwin-Williams, and that's not a bad way to go. There are some that are near, and those are for aristocrats. So then we've got Kings. Kings is a 50-year list. So with that list, must have increased its annual dividend for at least 50 consecutive years. They do not have to be in the S&P 500. So it can be smaller companies or even utilities that have shown resilience. And if we remove the 25 years from that list, because those aristocrats are in the dividend kings list, but I want to take those out, right? So we don't see them twice. Then what we're left with is a much smaller list. I think it was 30 something stocks once we removed the aristocrats from the kings list. And it's got like Pepsi, Coke, Walmart, Target, Johnson and Johnson. So not bad, right? Now, on top of that, there are names that are close to hitting that 50-year mark, but they're not there yet. Consolidated Edison, Nextera Energy, and ExxonMobil are getting close. Well, Nextera is sitting at 30, so it's not close, but Consolidated Edison is right near that 50-year milestone, and Exxon Mobil's at 43 years. So that's pretty good. There are other smaller lists, dividend contenders. That would be 25 years. It's much like the aristocrats, but it can be companies not in the S&P 500. Then there's another one, 10 to 24 years. So we haven't even hit the 25-year benchmark yet. Then there's challengers, that's 5 to 9 years, and dividend zombies, which when I didn't even know about this one, but it makes sense. When I seen the word zombies, I thought, oh, it's probably a trash list, but it's oddly not that. It says that the dividend zombies list is a very rare informal category for companies that have paid, although not necessarily increased, dividends for over a century. So 100 years. I didn't even know about that list. Some investors choose a middle path, looking for the challengers or the contenders, companies that have a 10 to 15-year streak with a 3% starting yield and an 8% growth rate. But you do want to be specific, like I mentioned earlier, on if you're going to build a portfolio, which kind do you want? And you can do both. You can mix it up. It doesn't have to be one or the other. But you have your immediate income type portfolios, and then you have your long-term compounding portfolio. If you want to search on the internet and find more about it, search for something called the dividend growth investing, DGI. That will help narrow down the searches that you're hunting for. So if you're looking to get a paycheck or fund your retirement through an immediate dividend income, then you want to change the stocks that you're focused on, right? But you're going to need a large account to be able to own those stocks at a high enough level to generate income from it, right? That's why I was saying small accounts. This is not your path, right? This is not how you grow small accounts. It might be good for like a child, right? If you want to create an account for a child and buy them $100 of, I don't know, whatever, and let it grow over their lifetime, even that wouldn't get anywhere. You know what I mean? Like it's just not the way to go. So the primary metric for an income portfolio would be the current dividend yield. You're looking for a high starting yield, which is typically 4 to 7%. So like Altira here at 6%, that fits the bill, right? If you invest $100,000 in a 6% yield, you would get $6,000 in annual income immediately. Real estates or REITs, legally required to pay out 90% of its taxable income. Utilities like NEE or ED or SO, tobacco and energy names like Altira or PM, CVX. MLPs, master limited partnerships. These stocks often have low capital appreciation. The stock price might stay flat for years, and the dividend growth usually only keeps pace with inflation, which is often calculated at 2 or maybe 3%. So if you look at Altira and we put it out on a big boy chart, here's a monthly. Here's the 2018, 2017 high, and we're getting back 10 years later, 2026, we're just coming back into that same zone near the highs. So if you owned this for the last 10 years, then you made money on the dividend, and your cost on the capital side, the stock lost some money and then the stock made that money back. It's not bad, right? This is what we call a hedge fund hotel. Sleepy, boring, low, low beta. just doesn't do anything. Look how it recovered from the 07-08 housing crisis. What a move. That's very beautiful. 8 years just going from $14 to $74. Gotta love it. So you can get stuck in the weeds. You can, of course, learn the different maths. And depending on the platform that you use, you should be able to get the information that you want. And or you can ask AI. I didn't ask for a specific name or what the yield would be on it, but I wouldn't be surprised if I could, right? Like I didn't do that. Instead, I just asked AI who was on the list because I didn't want to go buy the dividend list, right? And I'm glad I didn't have to. So you can do the legwork if you want to, but in this modern world, why would you feel the need to do that? Just use your broker and or AI or a combo of both and do it that way, or just use the list. I sent the list in the chat. Now I only sent 2 lists. One was the Kings and the other was the Aristocrat. So if you wanted to build something like the other ones that I named, the Zombies, Challengers, Contenders, and Champions, then you probably have to use AI for that. Thank you, babe. With the Dividend Kings, I believe this one is the Kings. Let's see. Nope, that's the Aristocrats. Let's go to the other. The Kings is a smaller list, I believe, now that I removed the Aristocrats from it. Doesn't feel that small. %. It's not a long list if we just look at 3%. It's like these top 20 names. ABT, that's a 3%. I'm on a weekly chart, so we're looking at 2025 into 2026. It hasn't had a nice time. Let's see if we can go out a little further. Let's try 15 years on a monthly. Oh, yeah. So that doesn't, I wouldn't want to go put money in this thing, right? Watch your money bleed off. Here's SYY. Now, it's recently taken a beat down from the highs, but it's coming down into this $70 structural level that has been holding since COVID, pretty much, right? Before COVID, we were still trying to set highs. But since COVID, I mean, that $65 level seems to be the lower end of things. Not bad. This has got an NA. We'll come back to that. PG. Now, if you haven't caught on yet, a lot of these names don't have good options. So the question originally was to have to use options to get the stock and to do that in a way to build out a portfolio dividend. Well, most of these companies are going to have crap options. So then you're stuck with the idea, well, how do you want to get the stock? You know, you don't have to do it with options. You could just buy the stock. So you're going to need some allocation process for picking up the stock. I know when I buy a lot of stock, I tend to get a little bit of buyer's remorse, unless, you know, it's just one of those lucky things where I bought it and it actually went up. Usually when I buy stock, it tends to go down a little bit more before it goes up. if I'm lucky and it goes up. So what I like to do when I'm buying stock is I don't buy it all at once. If I want 1,000 shares, then I'll break it up. I don't really have a fixed way to break it up. Sometimes I break it up into 10 different purchases. Sometimes I break it up into 4 purchases, right? Like there's no, um, I'm not that rigid. I'm a bit flexible. It wouldn't hurt to be more consistent, but when I break it up, a lot of times it's depending on, well, how much is the share price, and how much of it am I going to buy? And then I just kind of wing it. But what I have figured out is I don't want to buy it all at once. I want to average in dollar cost averaging, however you want to say it. I like that better. I've tried to add in as it goes up, and that's okay if it's going up. Um, you're putting more money into something that is proving you right, which is nice. But I've also done it the other way around, and I've put more money in when it's faded back lower than where I originally got in. And I like that too, because if it's something that I wanted to own long term, then I'm just buying it at a cheaper price. So there's no wrong in this, right? You can kind of just do it however you see fit. But one thing that I have found for myself is that if I want 1,000 shares and I go buy 1,000 shares and it drops overnight, I'm a little disgruntled, a bit salty, and I tend to end up getting out of it once it gets back above my entry. If it gets back above my entry, and or I end up stopping out, because even though it's a longer term trade, if I buy a lot of it all at once, I tend to be really mindful about how much it's lost in a short period of time. And of course, if you own a lot of stock, it doesn't take much movement before the dollar value of your loss gets big. And then, I get a little salty about it.
That's a good point, because now my strategy on it is I go in 20-30% of what I want. A lot of times I'll just start with like a 10% position right wherever it is. And then every day I come in, and if price is below my position, I add a little bit, and I'm averaging down. And so I check it every day, and I'll do it today around 3 o'clock here in about 15 minutes. I'll go in, and anything that I've got that either is below my initial entry price, it says I'm underwater a little bit, so I'll average down. Or if the chart shows me, this looks like a good dip buying opportunity, I'll add there as well. And that way, because in my case, what happens is I'll have this list of, let's just say 10 stocks that I'm watching. And some of it's just a matter of you get busy or discipline or whatever, and you just don't watch it every day because, well, no, not today. Well, no, not today. No, not today. Skip a day, skip a day, skip a day. No, not today. And you never do anything with it. So I buy at least a share, and that puts it on my board. And now that I've actually got a share or 10% of whatever I plan to do or whatever, then I come in and I have a little bit more motivation to come in and check it every day and say, well, how's it doing? And like I say, if it's a little below water, then okay, I'll average in. I'll average down by buying a few more shares. And, am I calling the dip? No, because to be honest, I never call the dip right. I never, ever get the perfect entry. Because a lot of times, by the time something hits my board, it's already hit the dip and people started buying into it, and I've missed that dip buying opportunity. And I'm not the kind of person. Now, some people are, and I'm not faulting any of this, is just personality. Some people will go through 100 charts a day. And if they enjoy that, whatever, fine. I'm not that kind of person. I don't have the patience to just sit here and blindly go through 100 charts every day. That is so boring. I can't do it. But the point being is that Cygnet's 100% right. You don't just take a full position right off the bat. Every time that I've done that in the past, I lose my ass. and that's just the way it is. So the lesson that I learned over time was I take 10, 15, maybe 20% if I really think it's in a fantastic position. Yeah, maybe I'll take even more, 25%. But I'm not going all in. No, not me. I'll wait because it is going to have pullbacks. And even if you're, say, overall on some ticker, say Google, say you're up 5% on Google, and you're like, okay, well, that's nice. It's still going to have interim pullbacks that you still may be up 5%, but it's still a good place to add. And that's where you go in and you look at the chart and you say, well, look at the daily P&L. Well, if the daily P&L is down, but the overall P&L is up, you say, is this an adding position? Something that I might consider. And I'm going to look at the chart and say, based on my trading strategy, does it make sense to do that here and now? But yeah, every time I've gone in all 100, all in, I lose my ass. And so no, I agree with Sigmund on that 100%.
I've met people that don't mind getting all in all at once. I just my mindset, it does not work. I don't work that way. So I want people to realize that you can do it whatever suits you. But I mean, you heard you both the way we do it. You do you, and that's what's really important. If you can jump in with your whole position all at once and it doesn't bother you, then great, do that. But I've never been happy when I do that. Like unless it's one of those rare things where it just goes up, and then I don't know, maybe I just got bad luck, but usually I don't buy a stock and it immediately does exactly what I want it to do. I'm not getting that kind of love. And if you haven't noticed, if you don't like a position, you'll get out of it. You will get out of it. You'll find some excuse, some reason, something, and you'll get out of it. And I see people who try to go for long-term trades. They don't hold it 6 weeks and they're out. And I'm like, I thought that was going to be like a 2-year hold. Oh no, it winked and I got out of it. So, okay. I just installed an indicator. It was supposed to be a 5, 10, 30, and it's not doing anything. See if there's something wrong here. Oh, yeah, no, that never mind. That's yields, like the 5, the 10, the 30-year yields. No wonder I wasn't doing anything. Like, what's wrong with this? It's broken. While we're here, I guess we'll just put it on SPY, see if that fixes it. Go intraday, maybe? Nope. Probably wanted TNX or maybe 10-year. Yeah, I don't know. That wasn't what we were looking for. Which means the other one that I put in the chat also isn't what we were looking for. I've got so many indicators in that workbook. Let's try the dividend search. There we go. Dividend yield label. That's what I was looking for. If you guys don't know what I'm talking about, because there has been some new faces around here lately. Every day I share the Thinkorswim workbook, right? So this is a massive library that I've used over the years. Indicators that I've made or I found on the internet, and mostly it's Thinkorswim. There's a little bit of TradingView. Once you're in, and it's free, I don't charge anybody for it. I don't want to make money on this, mainly because I don't want somebody demanding that I do something or add something or provide something just because they paid to be in here. There's a search in the upper right. So if I search dividends up there, scroll down, here's dividend yield labels. I noticed there's some others here. Dividend reminder alerts. So we'll try this one. Beta correlation, discrete averaging, dividend yield right up here. And then yield alert. There's also some investor tools. If you want those, we'll just grab all three. Why not? Yeah. So the other one, by the way, I had posted some other stuff in the chat. Those were looking at bond yields. So that, like the 10-year bond, 30-year bond. Wow, look at the 30-year when I took that picture back then. It's over 5% right now, but it was at 2.5 back in the day. So there we go. Dividend yield label, dividend yield alert, and then some investor tools. I've already got a label, but we'll see if this label is better than the one that I'm using, because the one that I'm using is pretty generic. That's not. I'm just stuck in la la land today. Now, the one thing about using options to get the stock for, like stock allocation, you are choosing where you're going to get stock, right? Like if you sell a $10 put, then you get later on, you get the stock put to you. You're going to get it at $10. That's not hard to figure out. So not much of a buyer's remorse from that standpoint. And even sloppy options can accomplish that goal, right? Because you can get into sloppy options if you're willing to give a little, but it's getting out that's difficult. Well, if you got run over and you're going to get the stock put to you, you don't really have to worry about getting out. You're going to get out anyways. So in that regard, you could use something that doesn't necessarily pass the smell test for things we'd want to trade in the options world, because we're not really going to trade it. We're just going to be on one side. We're going to sell it to get the puts, and then we're going to run them until they expire and or we get the stock put to us. So in that regard, you don't have to be as restrictive as we normally would. So I added the indicator. I should have gave it a different name. Study -10. All right. I didn't name it when I first put it in. This one. We'll see if it's better than the one that I'm using. It at least has some color to it, but it doesn't seem to be better. We don't need that one. This is the one that I was using on the Walmart earlier, that white labeled one. And I just put the words above 3 is good so that, you could be reminded all the time. And this is the other one. I think the one that I just installed changes colors, as opposed to that one that's white. It doesn't change colors. Yeah, if closes, okay, it isn't changing based on the as percent. It's only changing based on whether the close was positive or negative. That's not helpful. I was gonna make one of these that changed color if it was below 3% or above 3%, but yeah, I didn't do that. And looking at what's written up here, I also didn't make this one. It looks like it came from the group who does a lot of coding with Mobius. I don't know that they have a name, but he's in this like coders group, or was back in the day. And this guy was one of them coders that hung out with him. So this is the same formula. It just changes color based on whether today's candle was positive or negative. No difference between those two otherwise. So you get a list of stocks, either from the Aristocrat or the Kings. You can go in and you can see when they pay and start working out which way you want to go here. There's no wrong way to go with this, other than trying to define whether you're going to be that short-term trader. You're looking for a daily payout, or not daily, but an investor over the long period, or someone who's looking for income, either monthly, quarterly. Here's what my notes look like, and I'm willing to share this. There's nothing in these notes that are a secret. Um, that dividend payout ratio, there's the math for it, and a little bit of notes. The ideal range would be from 30 to 60. A ratio over 80 or 90 suggests that the dividend is a bit burned and could be at risk of getting cut if the business runs into trouble. You might also want to look at the free cash flow. Look at the dividend per share versus the free cash flow per share. If a company is consistently generating more cash than it pays out, then the dividend is probably sound. We could check to see if Thinkorswim has a column for cash flow. I think they have it in the search. Like if I was to run a scan, I think I can do cash flow there. I'm just not sure that it's in here. So we'll take a peek. Free cash flow per share. Imagine that. So we can look at that versus dividend per share and see if the number is larger or smaller. It would be those last two columns right there. Free cash flow, $6 per share, 51 cents. Thinkorswim uses brackets for negative numbers rather than putting a minus sign on there. So that's not positive $6.61. That's negative. They don't have a cash flow. Maybe that's like my daughter's cash flow. She doesn't have one either. Clorox is $3 versus $1.64. Or Altira right there, $5.14 versus basically $4. And if we can find watch list columns like that, then I'm pretty sure we can code an indicator that will tell us, if the payout is good, if their free cash flow coverage is on the right side or not. That way we don't have to sit there and do it. What would be cool is if you could then search for those, and then even if they're not aristocrats and kings, they could still hit your scanner. Then you got the dividend growth rate, or the inflation hedge. Yield is what you get today. Growth is what you get tomorrow. The metric would be looking for the 5-year dividend growth rate, CAGR. If a stock has a low yield, 2%, but grows its dividends by 10% every year, your yield on cost would eventually surpass a high yield stagnant stock. This is what I was saying. If you're going to take a long-term dividend growth investment approach versus an income approach, because if you're going to run with an income approach, you want that high payout right up front. You're not worried about how much it's going to grow its dividend year over year, or not as worried. And if I'm going too fast, or I'm confusing you, or you've got questions, by all means, hop in, because I don't want to talk to myself,
I got a question.
Yeah.
Sorry, I'm glad you asked. I was getting a bit thick. Right, okay, with regards to that, so what you want is you want a nice, I'm looking, just to let you know just to give it some context, I'm looking at compounding. So buying stuff, holding it long term, which I've already proven I could do with my British account. So I tend to buy, like, we get our British equivalent of a Roth IRA or whatever it is, ISA, where it's tax free, and we can buy individual British stocks, which I've done. And I've just been buying the British stocks that are in an ETF, like our equivalent of your dividend, your aristocratic dividend stocks. I just buy the stocks individually, and I hold them forever. I never sell them. So again, that's what I'm looking to do here. But obviously, it's not so much that I want, like some stocks will pay an 8% dividend, which is great. But yeah, what's it going to be doing in 10, 15, 20 years time when I retire, So obviously looking forward, is that what you'd be looking for then? That if you go back down, what was it? The CAGR, that was it. So what you're looking for is you're looking for 2% today, but you also want that sort of same 2%, but in 20 years' time. So you want the inflation to be this. You want it to account for inflation. So you want it to grow by 10% every year. So 2% would be 2.02%. Yeah. And then the next year, 2.04% or whatever.
Right. If you want to see that it is growing, right? That it's continuing to grow its dividend. So that's what you want to focus on. If it does have a low yield right now, but it does also show a projection or a history of growth, that would be a good thing to focus on. And it's called dividend growth rate. You would want to measure its dividend growth rate.
So if you just say, for example, that your aristocratic dividend ETF, right, had like 10 stocks in it. I can't remember what they are now. Altria, ExxonMobil, and like 10 really good stocks that do that. They grow their dividend by 10% every year. Would it not just be a good strategy to look at your aristocratic ETF and pull out the stocks that are in there? Could you be reasonably confident that they would give you that yield growth?
I would not. I would say that I would need to calculate for each one of those. If it's in there, it shows that they increased it every year. But if they're only increasing it by 1 penny, just to be able to say that they increased it, see what I mean?
I see what you mean. I got you. Right. It's not the same thing. Got you.
Yeah, not the same thing. Checking a box to say that they grew, I mean, I get it. They don't want to lose their spot on the list, and it might be a tight year and they just tick it up a penny and they're like, we grew. Yeah, thanks, but no thanks,
So just out of curiosity then, is there an ETF that would satisfy that criteria that you could pick stocks from?
Maybe not a free one.
Ah, right, okay.
To calculate the growth rate manually, a lot of places will have a CAGR, right? Like, I'm sure, let's see if we can bring it up on Thinkorswim.
I don't think Thinkorswim or Stock Rover have CAGR.
They do not. But
which is really annoying. But now Seeking Alpha will give it to you.
Don't get me wrong, it's not the most difficult thing in the world to work out, but I'm just wondering if there was an ETF that would sort of give you some pre-picked stocks that would satisfy that criteria. But if there's not, no drama. I can calculate that myself. I'm reasonably confident I could do that.
When it comes to that sort of thing, I just go ask AI, which I just did. It's chewing on it.
Okay.
The iShares Core Dividend Growth ETF. It's widely considered a gold standard for the CAGR-focused investors. It requires companies to have at least 5 years of consecutive dividend growth and a sustainable payout ratio under 75% for most sectors.
Ask it, is it really sure, and where's its source coming from, and what's its ticker symbol? I want to go through those myself and check.
DGRO, iShares Core Dividend Growth ETF. And from that, of course, you could dig all into the company behind it, what the names are inside of it. I just put it in the chat. DGRO. Schwab has their version, SCHD.
I've looked at that one, yeah.
But that
sorry?
doesn't do growth. It just does high yields.
Yes, there's a difference. I looked into that, and I can remember thinking about that before, like a couple of months ago when I looked into it.
And then there's VIG, VIG.
Yeah.
And the First Trust Rising Dividend Achievers. This is aggressive KEGAR list. It screens for companies with high cash flow to debt and massive dividend growth over the last 3 to 5 years. It's been one of the top performing dividend ETFs over the last decade because it captures companies in their hyper growth dividend phase. Well,
Okay.
that sounds like chocolate pudding.
What's the ticker for that?
RDVY.
I've heard of that one as well. RDVY. Romeo Delta Victor Yankee.
Yep.
And that first one was Delta Golf Romeo Oscar.
Yep.
Cool.
All of those are posted in the chat.
Oh, right. Okay. I missed it. Thanks, Sig.
Yep. And you can go to the ETF's websites, so iShares, Schwab, whatever, and go to the holdings page and then download a CVS file of their holdings.
You could probably, right? You know, if you've got Trading View.
Yeah, it'll often have holdings too. So will Think or Swim, depending on what ETF you're looking at.
Yeah. Trading View does it. It'll break it down to what it's containing. And I bet you any money, right, that a lot of these ETFs will hold the same holdings and they'll overlap. Like you can almost guarantee like Pepsi's or Coke is going to be in all of them, McDonald's is going to be in all of them, or something like that, you know?
Yeah. Yeah, because you know, it's names that hit the criteria are gonna bleed over into each of the different ETFs.
Yeah, that's what I'm saying. I mean, effectively, all you're doing is you're setting your criteria using an ETF instead of doing the technical analysis yourself, really, which is a bit lazy, but you know.
Yeah, but you know, like I went through and did a lot of this legwork when I first got into dividend stuff myself, and I got a big headache. You know, I learned a lot. I didn't remember any of it now a couple years later, but I learned a lot. I studied the math. I had it all figured out. I could do the work. And then I thought, why the hell would I want to do all this work? You know, my family's always asking me, am I ever coming out of the office? My friends disappeared, you know, like, are you alive in there? So why do the work when we can just take the shortcut? You know, because I didn't get ahead. I didn't make more money because I did all that work. The outcome was the same. You end up with the same list that they end up with.
And yeah, exactly. And like I say, I mean, good companies are good companies. You know, if that company's in quite a few different ETFs, then it's probably worth. And if you're going to hold it for a long time, then you know it's probably going to be worth buying into. You know, it's just a case of getting the options set up to.
Well, the difference being with an ETF is the weighting of each ticker in the portfolio. Now, there's an argument to be, because a lot of people say, well, just like you say, well, NASDAQ, I don't know that I want NVIDIA to be that heavy in the QQQs. But there's an argument to be said that there's a fund manager, and this fund manager has a research team and has dug and dug and dug and has a reason for the weighting the way it is. SCHD has been an old name around for a long time because it grows both in stock value and in dividend. And one thing to remember about a dividend is that it's a dividend based on the stock value. So every year, every quarter when they declare, or month or whatever, when they declare a dividend, they'll say so many cents per share or whatever, but the value of the stock is part of the formula in figuring out what the amount per share is going to be. So when you see a yield of like, oh, the yield is 5%. Well, if the stock, as long as if you hold say you hold a ticker, take SGOV, SGOV, which is short-term government treasuries. If you hold that and it stays around $100, stays around 100 US for the next 10 years, and you say, well, I'm getting 4%. Yeah, but $100 10 years from now doesn't have the same spending power. So you're actually losing. So you're looking for something that, in my opinion, that not only does the dividend grow, but you're looking also for a growth stock. And that's where some of these ETFs really can come in, because they will go in and rebalance the portfolio.
Yeah.
Now, the question we have to ask ourselves is, do I agree with the weighting of it? And like I said, there's an argument to be said that there's some big professional out here that has done all the math and all the research and has weighted it accordingly, based on his or her or their research, whatever, as opposed to people like me and you individually saying, well, I think I'd rather have 5% instead of 12% of my portfolio. Blah, blah, okay, whichever. It's a question of whether you want to set it and forget it. DGRO is another one that's been around a while, and it got a lot of popularity. The ones you really, really, really got to watch out are the yield max ones. Man, people peed in their pants over those when they first came out. But the problem with yield max, was they were showing 10% a month in payouts. And you're like, no way. But the value of the ETF was plummeting every month. So they're literally designed to go to zero, I think, in my opinion, I'm not a whatever. So yeah, we definitely want to look for CAGR, and we want to look for price stability and price growth and appreciation. We want to look for a good entry. But just remember that if inflation is 3% and SGOV, SGOV, which is the short-term government treasuries, is 3%, then all you're doing is breaking even with inflation. You're not growing because SGOV's dollar value stays at around $100. Always has, always will, for the most part. 97 to 103 plus or, around in that area. So, and the other thing to remember too is that you have to ask yourself, and I'm speaking in US terms, so you have to convert it to pound sterling or whatever, but
no, I've got two different accounts. Obviously, I've got my British brokerage, and I've also got an American brokerage. So I've got like Tastyworks, which is US.
So the thing to remember is that if, dividend retirement is for people that have spent a lifetime putting $1 to $2 to $3 million in the account. Because stop and think about that for a minute. If you got $1 million and it pays 4%, well, that's only $40,000 a year. And when you are 40 years older, and we have a saying in the US that the value of the value of the dollar doubles, or the halves, every 20 years. So a dollar today would buy 25 cents worth of material in 40 years. So you ask yourself, well, if I get $40,000 today on $1 million and I take that dividend out, and don't reinvest it and don't grow it, well, then 25, then $40,000 becomes $10,000 of living money 40 years from now. So you just have to keep pushing money into it over and over and over, and you've got to get it up, quite frankly, into seven figures. And so the point I'm trying to make here, and Sigmund's talked about it as well, and I'm not saying to anything that you said specifically, Victoria, but just in general to anybody listening, is that you don't just set and forget an interest-bearing account and say, well, I've set it to reinvest. No, you got to continue to add and add and add and add to it, because you're looking at, say 20 more years until you 20 to maybe 30 years until you retire. And if you ain't got enough money in it, inflation will destroy it to the point that, 30 years from now, you say, well, I got $2 million in there, but it only gives me $15,000 a year in spending power. Who wants to live on that? So yeah, we still have to look for ways to push and push and push money into that thing over and over and over. And that's where our 401ks and our IRAs and stuff like that really can make a huge difference, especially if you like to do self-directed, or you got a company that's, has a good track record. The problem with a lot of these companies with a good track record is it's not their money. And so if it loses value, they don't care, other than the fact that they lose reputation, but it doesn't bother. They don't lose a lot of sleep over it. Whereas, you and I will pay a lot more attention to our portfolio than they will. So, but we have to be more educated and pick the right things and be active with it. But yeah, in the end, you want to live on dividends. In the end, you gotta push the money into it and let it reinvest over and over and over.
Yeah.
I found the one that I was looking for. This one label gives you the PE ratio, the dividend yield, and the payout ratio. And if you remember in the notes that I was showing earlier, that payout ratio is kind of a big deal, right? The dividend payout ratio. Some will argue it's the most important metric. It'll tell you what percentage of the company is paid out in dividends. Generally, 30 to 60% is a good place to be. But depending on the type of company, it's not necessarily a perfect number. If you look at MO, this is a quote bad company. It's smoking, alcohol, those sort of companies, sin companies, they get their own little box. And so having a payout ratio above 60 in a center, not necessarily all that bad. So no number when it comes to dividends is going to be just across the board easy to use. The more you learn about dividends, the more it'll help. And just ask AI if you're not sure. I sent that label over to AI and asked it if it was good, and it said, no, not really. What is this? And I told it was Altria, and it's like, oh yeah, no, hey, that's fine, because it's Altria. That's a decent number, not bad at all. But if this had been some other company, nah, I wouldn't have passed the smell test.
Why is that then? Just because it's sin stock?
Yeah.
I don't judge. If you want to smoke, drink, and gamble, you do you.
Yeah, I've noticed that people who let loose tend to be a bit happier than those who are uptight all the time. But I ain't here to judge. Yeah. But we can't treat tech stocks like we treat, real estate stocks. So it should matter to us how a company is performing and how much of their company is going out the door to investors, and what they do with their money. So I guess it makes sense. But whenever you're in doubt, just talk to AI. I've talked to people about using AI, and they're like, well, what's my prompt? What should I say exactly? And I literally talk to my AI on my phone. I just hit the microphone and I just talk to it like, hey, I got a question for you. Me and my buddy was chatting about, and I just tell the story, right? And then I hit the button and I get my response. I don't have these pre-written prompts that I feed it. I just tell it what I'm trying to accomplish, or what I'm interested in learning or trying to understand, and I let it go from there.
So, sorry, Sig, right? You know, you were showing us this earlier and you did go over the options. Can you just go over the options one more time? Basically, we're looking for a put on this, aren't we?
Yeah, you want to sell puts to get the stock, right? So
Sell puts to get the stock. Thank you. Right.
so
I
normally
never-
I'm very particular about what I will trade when it comes to options, because I need a two-way street, right? I want to get in and I want to get out. But if
Well, do
your
we?
only goal is to get the stock, you don't need to get out. You just need to get in.
Yeah.
And that means if it has options, then it is, quote, optionable. Then, that's the only qualification is, does it have an option that I can sell? The end.
Hmm.
You can put qualifications on it and say you want liquidity and it needs to have open interest. But at the end of the day, none of that's true. You're
As long
just
as
going
you
to,
remember that you're picking up 100 shares
right.
and you need to have that cash, whatever that put is. If that's a $25 put, you got to have $2,500 free
Yeah.
cash in your
But
account.
if I was going to be built like the way I built my British portfolio, right, and I'm just going back to give you context on what my goal is here. When I was buying the stock, I would buy it in like 1,500 chunks. So, all right, it's not 2,500, but my point is, I would buy in £1,000 chunks. So I would do that anyway, which again kind of like feeds into why I'm happy to do this, because I don't want to be fiddling around. Because if you've got a lot of money to invest, you can't fiddle about in little £100 chunks. It'll take you forever. You want to be doing like, £1,000 a week if you've got the money to put into it. Like, say for example, you sold a business and you just want to get your money into the dividend portfolio and you want to build it up, then you want to be doing it in big in chunks like that anyway.
So there is no qualification on the option side other than, does it have options? Because all you're going to
Yeah.
do is sell the put and then wait to get assigned and have the stock put to you. Now, if you're, going to dance around, which is what you just described as what you don't want to do, then the put you would be selling is something near the money or at the money so that you actually get money for it. And it forces the stock to either go up or give you the shares, right? And that's like a line in the sand that says you're either going to move your butt and go, or you're going to give me that stock. How far out do you want to go? That is on a time frame for you to decide. But I don't like going out 2 years, 3 years, 5 years if I want the stock, right? I'll go out 1 month, 2 months and draw that line in the sand and say, you will either get up and go, or you're just going to give me that stock. One or the other, take a pick. And it forces the situation. So I'm not in limbo, right? I want to just move on. You know what I mean? Like, let's go. I don't want to be messing with it day after day, wondering, am I there yet? Am I there yet? And I don't want to be hanging on to it for 3 years. So time frame, less than 100 days. What location? I want to sell the put and actually get money for it. So I don't want to be way out in the 10 delta, 12 delta. I want to be right against the money or even in the money. If I'm looking at, 50-cent strikes, I don't mind being in the money. I could sell this put for like 283, 285. And that'd be a good place to start right there, because I'm either going to get that credit and pick up the stock on a bit of a discount, or I'm just going to get the money and then I'll sell another put later. If I got assigned with this, it would be 280 minus $15. Let's just say if it was 250, then I picked up the stock for $12.50 a piece. I actually picked up the stock for $12.28. That's not bad. If I was assigned at 15, but I really own it for $12.30, I'll take that.
Yeah. So you're either getting discounted or you're getting paid to wait.
Right. And I didn't have to wait long. That's a 65-day option. And it forces the issue. I'm either going to get the stock or I'm going to get paid and I'll sell another put. But what I see a lot of YouTubers talk about is they'll say, oh, go way out of the money, and sell this one for 10 cents.
I don't take any advice from TikTok or anything.
Well, sadly enough, I see that same conversation on bigger social sites like Tasty and You know, it is a common logic to go out of the money and sell options. And I'm not a fan of doing that. I just think it really sucks. I'm not saying I never do it, but I have to have a really good reason to do it. My default is to be near the money, at the money, or even in the money, depending on my goal. Very rarely do I go into the 20s and the 15s and sell an option.
So, Sig, if you don't mind me asking, both this is for you and Mazidi. Then, have you two ever built a stock dividend portfolio, and have you used this method of getting in?
I did one time built a stock portfolio, and my way of doing stuff is a whittle down, American term meaning to chip away, take something, and I would start with yield. Show me everything that's got at least 5% yield. And then I would say, okay, now, so I get 200 entries. And then I would whittle down by market cap and say, okay, it's got to be at least $1 billion company. Well, 200 becomes 150 and so on. And, and then I may do this. Then I put another criteria and another criteria until I get down. And then I say, okay, I don't want multiple things in the same sector. I don't want 5 things in automotive, for example. And I did that for a while. And the reason that I did it was because I was taking a break from trading. And because I was not going to be actively trading. So I didn't want just money sitting casually in my account, just doing nothing. So I moved into dividends while I was taking a break for a couple months, or about 6 months kind of thing. So then I made a little bit. Now, at the moment, probably half my account is in short-term government bonds, SGov, SGOV, and BIL. It is not going to stay there. I am moving, in my case, now this is just me, there's a concept called financial repression, which means that the interest rates get pushed down intentionally down below inflation, which makes it easier for companies to borrow money and new homeowners to get mortgages. And it causes an economy boom. And it also is a way that the government deals with the debt problem, because what they're essentially trying to do is let inflation
Eat away the debt, yeah.
eat away at the debt. And I personally think that is coming. That is a long, slow process. It's not austerity. Austerity is a lot of pain for a short period of time. Repression is a little bit of pain for a long period of time. But I think that's probably where we're going. I'm not a macro person. Signet knows macros 100 times better than I do. So I'm not an expert. I spent hours and hours scouring, going through chat GPTs and researching.
Well, that's a fair assessment. I've heard a lot of people who seem to know what they're talking about as well, who study the bond market, and they're under the same impression that that's what we're doing.
So I am moving my portfolio over into one that works fine as if we stay where we are, but also benefits if we go into repression. So I'm in about 1/3 of my positions.
So are you cycling into a different sector then, as in stocks, because you think we're going into repression?
Yeah, I'm moving. It's mostly a matter of saying, okay, here's my list. And I go in and I look at the chart and I say, where are entry points? Some stocks are so up there in the moon, in the stratosphere right now, No, I'm not going to take an entry on a stock that's in the stratosphere right now. That's foolish. But, so I'm waiting for the pullback. Now, but others I've already started taking positions in.
Yeah, I took a load of positions in oil stocks just before they exploded. So
Okay.
that was a good idea. But they were looking like they were tanking, and they're probably going to pull back again, and I'm going to take some more. But the sectors I was looking to get into were going to be commodities, so things like oil, agriculture, mining, minerals, that sort of thing. I discussed this with Sick before. So yeah, I get the sector rotation that we're going into, and I understand why people are doing it. But
yeah, most people do like sector rotation as a model, and traditionally it shows about a 12 to 17% performance per year. Which is
no, though, Mazzy, is that what your sort of plan is?
Well, I'm not doing sector rotation so much, but it is a trading strategy. The idea is you come in every Monday and you look at which sectors are up and you just buy them, and the ones, and you rotate into the top 3 sectors every Monday morning. And
I was looking at a bigger sort of like time scale than every week. But yeah, okay.
But anyway, that's not me. That's not me. I'm just saying that strategy. No.
So for me,
yeah, go ahead.
I didn't. I've never been a fan of taking a massive amount of money in any one of my accounts. I've grown all of my accounts. Every one of them, I've had to grow them out from little things into bigger things. And it got to the point where I had an account that was pretty fat, and I wanted to get into the dividend from one side because I wanted to be able to teach it and explain it and help others learn how to do it. And I thought, well, how can I do that unless I've done it myself? So I went with the short-term investing route rather than the long-term, because I wanted some experience doing it so I could teach it. And the outcome of all of it is I didn't like any of it. I didn't like being forced into a box to have to choose from this list of stocks that I may or may not like just because it meets these qualifications for dividend. And I did not like the income list at all. The longer term list, I liked those, but I wasn't trying to put together that list. So what I finally came up with from the dividend perspective is I trade what I want to trade. And if I have to choose between a company that has dividends or not, then I will lean to the one with the dividends.
Yeah.
I found that worked so much better because I don't know if I'm just picky or what, but I would see a company and I'm like, I don't like you. I don't like the chart. I don't like the options. I don't like you. I don't want it. And of course, if I don't, if I don't like it, I'm gonna find a way to get out of it. So now I trade what I want, and if I have to choose between one that has dividend or no, then I'll choose the one with dividend. Sure.
Would you use options to get into them though?
No, because I'm me.
Okay, all right. Because trading is all about knowing yourself. The more I go in, the more I'm working this out. But like I say, my British dividend portfolio is doing quite well, only because I buy stuff and I just leave it in there. And I think I've only ever sold like 2 stocks in my entire life, and I regret selling those. But yeah. So I know I can do it. I know I can. I've got the temperament to buy and hold. Even if it's down, I don't really care because it's still paying dividends, and that's all I care about really.
The thing about the options is it doesn't matter, right? Like if you're just using the options to allocate into stock, it can be the worst options in the world. It doesn't matter, right?
You're still going to get paid or you're going to get allocated.
Right.
I need to take the plunge with this. I've been talking about it too long. I need to actually do it.
Yeah, because at the end of the day, it's all about just getting in there. If you've got this pool of money that needs to be in the market, then you got to get it in the market.
Yes, sir. That's what I need. And the thing is, it's all sitting there in dollars now. Because what I've had to do as well is I've had to obviously jiggle about because I need an American brokerage account. I want as much money now in the States so that when I go for my green card application, I can say, see, I've been paying taxes and investing in the stock market, and I love the United States. Let me in. I love you guys. So I want this as well as a sort of like part of my green card application. So I want to show that I've got money invested in the United States as well. So it's good for that. But yeah, I just need to take the plunge with this.
Right now, you can just buy citizenship.
Yeah, I've heard about that. And I was looking into it. I am seriously looking into it.
That might be your best shot, because when the new administration comes in, there's no guarantee that it's going to stick around.
Yeah, because this is it. I could either use this money to buy citizenship, or I could use it to get an American dividend portfolio together. You know, which one? Which is the best?
I mean, they say it's the land of opportunity, right? That you might have more opportunities.
I'm reasonably confident I could make it in the States. I've got a lot of skills and everything.
I have found that anybody who has the heart to stand up and get after it can make it here. That's all it takes. And there are so many people who aren't willing to do that, who were born and raised here, who would just sit on their bum and complain about how bad everything is, and they're not willing to get up and do anything, and then they can't make it.
Yeah,
but those who reach, I've never seen anybody fail when they reach. I mean, we all get knocked on our bum, you know.
Oh yeah,
but you got to get back up. You know, it's how you get up when you get knocked down. That's what counts.
Yeah, I need to look into this. Is this money better off buying citizenship, or is it better off in a US stock portfolio? Because I've already got a British stock portfolio. It's not like I haven't got a stock portfolio. But what do I do with these dollars now? I'm trying to think. But yeah, I'm going to do it anyway. I'm going to stick some money in this and just learn how to use the options. And I know I talk about it a lot. I am going to get around to it one day, I promise. But no, this has been really useful.
I was glad that I did it, even though I didn't keep the investment portfolio for long. I don't even think I had it for 18 months before I finally got just completely fed up. But I was glad I did it. It was a good learning experience. So I would say it was a good journey. You know, some of the things I've tried in the markets was just like, dude, what was you thinking? But that one wasn't bad. I learned a lot from it. You know, and in the end, some of it didn't pay well, and then others paid out really well, and I kind of felt like I broke even at the end of it. Or I was down a little. I know I didn't come out a lot ahead, or I'd have been a lot more excited to do it again. So either I broke even, close, or I was down some, not enough to make me dislike the system. Just it just isn't my style of trading. And that's the thing. I am a trader. Investing is a whole different beast, and I tend to be much more lazy on the investing side. I like mutual funds, ETFs. I'm not much into long-term stock picking unless I'm bottom fishing angels and, you know, old school names like Ford and AT&T and that sort of stuff.
I've done those aristocrat dividend ETFs. Have any of those got options?
Oh yeah. Yeah, a lot of the dividend aristocrats have options.
Could you not just buy aristocrat ETFs in general? You know, if you just got like an S&P 500, a Nasdaq 100, and then a dividend aristocrat ETF, and just like traded options on those three ETFs, that will give you a nice wide, diversified portfolio of stocks.
Yeah, I mean, you could just do the same thing buying SPY.
Yeah, I guess. You wouldn't even have to do individual stocks. You could just trade options on the ETFs and then just build up your dividend portfolio like that. ETFs pay dividends, don't they?
Some,
yeah. Well, if I'm buying an aristocrat dividend ETF, I'm expecting some bloody dividend, you know?
Yeah, yeah.
I mean, I'm not expecting 4%, but 2.3% or something along those lines.
Are you doing all your work on Thinkorswim too?
No, I'm not. I use Tastywork, and I haven't used Thinkorswim for a long time. So, and this is it. This is what's holding me back actually, because the platform I'm using is Tastyworks. So I need to work out how to do that on there.
Yeah, see, I use different places. Like right now I'm on stock charts, and I like using stock charts, because I can leave notes and build lists. Like I can build a watch list that has all these detailed notes in it that I can see in the list while I'm looking at it. I don't know why that is so revolutionary, but I absolutely love it. It's so nice to be able to look at my list and be reminded about which EV company is, luxury cars and which EVs are the cheaper model cars, and just little notes that make life a little bit easier.
Like I tend to make my watch lists in trading.
Yep, I do love that, because then you can break your watch lists into groups and have little headers on them. I wish Thinkorswim would do that. Oh, that would just be so nice.
I do like trading for doing my sort of like watch list, and then I can just separate it into performance and then see what's done. I really like that.
When I put together something, I'm on stock charts here, and I put all of this together in January, where I was focused on AI and non-AI. So I had a diversified AI list and then an AI targeted list. I don't want to say anti-AI, but I had that list, military exposure to those rare earths. We were having problems, getting rare earth and how it was going to affect military defense, the space economy. So when I go and click on this list, if I go into my chart list view, this is my non-AI ETF exposure list. So I'll scroll down to the bottom so it'll explain what this list is, because it's got a nice little area for my notes. This list excludes the top 10 stocks, which are mostly tech, the profit growth in other sectors for 2026. So I'm looking for industrials, utilities, healthcare, and I listed their names behind it. Regionally, I had Eurozone, emerging markets in Japan, and then with the maximum defense, I had the XLs, XLI, XLV, XLU, and all of these were to focus on the AI ETF concentration and the problem of that AI ETF concentration. So manufacturing recovery and US dollar weakness rebound opportunities, allocating some satellite capital to undervalued Asia Pacific or European equities, or directly referencing the VT ETF. So that was my notes. When I scroll up, there's the utilities or the other utilities, because one is MX and BATS and the other one is NASDAQ. They're just different ones. Then we got the regular XLU, Japan, Europe, emerging markets. And this portfolio group has done really well this year. It's not just wow, but I'm doing pretty good. Caught a lot of the rotation. Robots, industrials, Arc Genomics.
What's that? It's agriculture.
It's genome. Think of gene editing, splicing, and
Oh wow.
medical devices and healthcare. Right? This is just one. This was diversified ETF exposure. Then I had another list that was AI targeted ETF exposure, and then another one. You know what I mean? Like this is how I think, and this is how I allocate money.
No, I see what you're doing. I can see what you're doing. You need to start one up for like different types of commodities, like agriculture.
Ooh, ag is hard. Ag is so hard.
I know. I've been looking into it, and it's really hard to sort of like get the general basics of agriculture and find stocks that like if you just wanted to buy somebody or buy a company that's out there making beef, right? Which is technically a slaughterhouse, I guess, but it also involves cows. So come on, I can't find one. I don't know what I'm looking for,
Yeah, and same thing with corn and wheat.
Yeah,
those are really big, and yet you would think there would be a big ETF to go with that, or at least just and nothing. I mean, there's some small stuff out there, and it's getting better, but it still sucks. bad options, bad chart. Like, I don't want to trade
That
that.
might be a good thing, because to be honest with you, we don't really want our food being run by mega companies. We want like individual farms to prosper. So in a way, that's kind of a good thing.
I would like an ETF that is focused on the cost of what corn is being sold for at the grain elevators. You know what I mean? I'm not asking for much. And that wouldn't be manipulated by the corporations. That would be, what is the farmer getting when he sells his corn to the grain elevators?
Yeah, that would be fair.
Yeah, you know what I mean? Otherwise, you know, I have to listen to my local news in the evening because I live in Kansas. It's a farm state.
Yeah.
And they have the cost of all of those agricultural products on the 5 o'clock news when I listen on the radio. And so
Hey.
they'll tell me what today's corn and wheat and soy and all of that was. And I'm sitting there scribbling like a madman. Of course, nowadays I just use AI and ask, you know, what's the price of corn today? But
We should create an ETF that reflects such a market. One of that word.
I don't think my AI diversify or my rare earth de-risk worked out that well. My military resources XAR didn't do good. PPA.
Yeah, but over what term?
This was from January to now. So, you know, I put this list together mid to late January, and this list hasn't really done that well. But you know, if you think back, China was holding back those rare earths, and it was causing us some problems near the beginning of the year, and that's kind of why this portfolio came together. And they changed their stance, and so it just didn't work out the way I had expected. But
See, I think longer term than that when I'm buying into ETFs. I really do. I just buy and hold them.
But some of the things that I was focused on was like U.S. military building modern defense networks, continuing supply chain de-risking. I thought we would do more of that. China rare earth battles were temporarily paused. The export controls on silver, South American copper disruptions, uranium structures. Like, this was all a part of my thinking when I was putting this list together.
Yeah, so you get an idea about how the world's going to go, what could be affected, and then you put the stocks, you put the ETFs into it.
Yep.
Based on that thesis.
That was the plan.
Oh, I still like that. I really like that. Yeah. I've done that with the spreadsheet, but in a far more basic and haphazard form. I've got like an idea.
This is a good site.
And then I think, yeah.
For that kind of work, it's a good site. The problem is it's not a free site, you know, but it has a lot of tools, and the more time you spend here, the more you can use those tools for different things. It's pretty handy. So hopefully you're ready to tackle the dividend world.
The American dividend world. I've already tackled the British one.
I think you got it. You know,
yeah, I need to figure out on Tasty Works how to do the option side of things. It's not the dividend, or it's not even picking the stock. It's how do I set up the option. I'm going to get on your case about it one day, so you can say, hey, just sit down with me for 5 minutes and show me what to do on this damn platform, and then I'll be away to go. But I know I talk a lot, but I am getting around to this, I promise you.
The Tasty platform is real easy. So that, you're right, it won't even take 5 minutes. We'll be able to run right through that.
Maybe if we're not too busy in a month or so, we could have a Tasty Works platform with options. You could go through that.
Yep, can do.
I'll put that. I won't do it next week. I've already commandeered this week, but maybe in a week or so, in a couple of weeks or so, I'll ask you to investigate that.
Yeah.
Thanks, Nick. I really appreciate it. This has been really helpful. Thank you.
Glad to help. Let's see what Microsoft has to say here. It is a bit beaten down compared to its peers. There's a number of reasons for this. The payout ratio doesn't match that 30 to 60 window that we're looking for. The yield is really low. But just leaving all the dividend stuff out of it and focusing on the stock itself, if we look at Microsoft versus its peers, some of them are doing better than this, but put it on a larger time frame. Yeah, we broke that trend line, but I mean, look at where we've come from and look at this pullback. What I've been focused on with Microsoft is that pivot point right there. I really don't want to see this higher low get broken, right? So if we stay above it and we keep up that higher low, I'm going to be happy with this. And we want to focus on this high and this low and the midpoint, basically that big bar right there, last month's bar. If we can break out above that bar, then we've got a shot at getting back up here to the highs. But we got some problems. One is seasonality. We're in this election year mid-cycle, and everybody's waiting for the pullback that's supposed to come. Like it hasn't missed in 100 years. So, it's like maybe this time is going to be different, maybe not, but we're all looking for it. We've had a big run up, and if we get the pullback that we're all waiting for, and this one's already pulled back, then maybe it doesn't have much farther to go. And so it could consolidate in this range and then be one of the early runners when we start coming out of this by July, August into September. We get through the elections and then we start that rally back up that everybody's also looking for, right? So the fact that it hasn't rallied up with the rest of them doesn't disappoint me, really. I just would wait until we get the pullback for elections that we're all waiting for. And this would be one of my go-to for the recovery side of things. But it is one of the big dogs. And so in a situation like this, when a big dog has been down, you got your 5-bar rule. We've popped up. We've got a bear flag forming. And it is a potential failed bear flag. If it drops back down below 786, then that means it can come back down to the 0 line. We're still above it at the moment, basically $400. I would want to see this prove to me that it's not going to break that low, that 350 or 345, whatever it was. If it holds around here, just chopping about, that'd be great. Basically under 50%. And not lower than 1236. It can just stay in that range. I'd be okay with it. If we break below the 1236, then we're going to go down here, and that's not cool. I wouldn't want to be along for that ride. But if it hangs out in that zone, it's more likely we're going back up here. As long as they don't screw up somewhere with their money, right? Like Meta went all stupid and was doing $1 million sign-on bonuses and hired every AI guy out there, and now they got punished on their earnings, right? So if they don't do something like Meta and get some wild name out there, then hopefully they won't get punished by investors for spending, and then they just need to start showing us that those agents are going to be able to be monetized. That's the promise anyways. And if they can prove that, the stock should run right back up. But I wouldn't try to catch a falling knife. We don't know that we're on the move back up yet. And we're all waiting for the mid-year drop. And you don't want to watch the equities for that drop. You want to watch the ETFs, the index ETFs, SPY, the Qs. When is that big mid-year election drop coming in? Are we there yet? We're not there yet. Probably a 8 to 12% drawdown for the elections, and then we'll come out of that. It's supposed to be like an 18% rally off the lows. So if we drop 8 to 12 and then we recover 18 to 22, we'll still be up, like 6 to 8% on the year going into the end of the year. Sounds about right. The average returns on SPY. That's what I'm looking at anyways. I don't know. There's still the issue of global debt crisis and global energy crisis and a couple of wars, and what if the president says something about Taiwan and things get wild next, 2 days? All it's going to take is just one comment. If you are looking for an entry into Microsoft, you had earnings and this bar the day after earnings. We don't want to go below the 111 of that. So if you're looking to get long, $390 would be as low as I would want to see it go. And really, I wouldn't even want it to be there. $395 sounds better, because we're inside that earnings bar. And when you have an event bar like that, it should match 50% or better, which we did. Now we're back down in here just digesting that earnings, and everybody's getting comfortable with the new information. So we could overshoot on the downside a little bit. It's kind of like a zipper play. And after the up and the down, we should balance somewhere in the middle until it's time to go, and then move upward from there. I like Microsoft, but I give leeway to Mag 7 names. I give them the benefit of the doubt because they are Mag 7 names. It hasn't let me down yet. Sooner or later, someday it will, I'm sure. So, hey guys, it's 4 o'clock. Unless y'all got any questions, we could wrap it up, call it a day. Always looking for topics to cover on Friday. I don't have anything lined up yet. I will. If nobody has a topic, then I'll just come up with something, but just throwing it out there. We don't have a topic for Friday yet.
Sounds like a plan.
I know that Lucian made a post earlier today about the new, whatever it was, the changes to the Bullish Bears. So if anybody is monthly members or yearly members, there's a lifetime access model that is running until the 19th. Something to think about.
So there's a lifetime, and what was the other? I know there's a monthly, and what's the other one?
There's a monthly, yearly, and lifetime.
Okay.
And it's on sale. It's $500 right now. It's gonna be, looks like 1,000 later.
Woo! Why are they raising it?
I don't know. Over the years, he's tried different models, and it's been a while since we've changed. Got to change and grow.
Okay.
We had different programs over the years.
Okay. All right.
There's a link if you guys. I'll repost it. But if you scroll up earlier today, you'll see the link that Lucian had put in.
Just one last thing, just a question. Those guys meeting in China, what would you guess that they're trying to do now? What's the plan? It seems like they got something cooking.
I was listening to a panel discussion on this earlier, and one of the panelists was like, oh, well, they're not going to accomplish anything because they're just not going to be there long enough to get anything done. And I'm like, well, then what the hell did everybody get on the plane for? Right? Because we got like all the Mag 7 CEOs are over there. Why did they even go if nothing's going to get done? So I don't know. I know that each one of them is trying to sell something to China, and they also want to convince the president to allow China to have access to things like the the chips from NVIDIA, for an example, just for an easy one off the top of the list. Boeing with their planes. So they're all trying to sell something to China. Some of them are trying to convince the president to allow China to buy some things. The president wants China to help them with the Strait of Hormuz and the Iran situation. So, it's a laundry list of stuff depending on which market you're talking about, or which company, or which person.
Okay. Oh, we'll soon find out. I know the market seemed to be partying off of that news, today. So
there's a lot of hope, and that's the thing. There really is just a short amount of time. And somebody even had this really sour comment, about putting such global leaders all on one plane. That's a scary thought, to have. What if something happened to that plane? I would have rode my own plane. When you think about it, if you're that rich, get your own plane.
Maybe that's why the NVIDIA guy took it to a separate plane.
Smart guy, because I would not want to be on the plane with everybody else. It's just too hot of a target.
Yeah.
It's just an Epstein party. Nothing to see here. Keep moving on.
Cold, man. That's cold. Probably true, but cold, man. That's cold. I certainly don't have no love for the global leaders out there that do dirty shenanigans behind closed doors.
Especially with children.
Oh, man. What a mess.
Hey, Signet, I just heard something about you guys were talking about an update to the services through the Bullish Bears. Is that if I already have lifetime access, which I got last year at like the 4th of July sale or whatever, that doesn't affect me, does it?
Nope.
Okay. Thank you.
Yep. The post that I linked is just referencing what Lucian had put in earlier. So if anybody wants to click on it, scroll back up to it. For anybody on YouTube who's watching the stream, I guess it would make sense to show it. What am I doing trying to hunt for it? I can just click the link. All right, there. So the lifetime access, if it's all right here, you can just click the link. You can lock in your access before everything moves to a new monthly model. For the lifetime access question that was just asked to me, type that out so I can send it to Lucian, because I want to hear his answer. I say you're probably fine and there's nothing wrong, but let's check and make sure, right? So type it out. I'll give it to Lucian and we'll get his answer, because this ain't my company. I might say yes and he might say something else. I don't know. I would think
Well,
you're fine.
I would think that it would be, because, I mean, if you pay for lifetime for the website and everything like that, I would think it'd be lifetime. I mean, be grandfathered in. I mean, that's, to me, is what I would think it would be, unless they're changing something or, what have you, which, I don't think they are, because I got all the classes and stuff like that, which I'm starting to go through. So, I would hope they wouldn't take away my access after paying for it.
No, yeah, the website access is not in question. I think the Discord access might be in question. I don't know. That's why I said write it out and I'll give it to Lucian to make sure.
But I thought that was included in that.
I don't know. Is what I'm trying to tell you. I gave you my off the cuff answer of, yeah, you should be fine, but I don't know, because I'm not the one making any decisions, and I haven't looked at membership in 7 years, and it's changed in 7 years. I don't know what you bought last year, because I don't even know what was offered last year. You know what I mean? Like, I don't know. I work here part-time on a Wednesday, Friday afternoon stream, and I don't do anything with memberships or anything like that. So I don't know. And I'd rather give you a good answer So if you type it up, I'll give it to him, and then we'll have a for sure answer instead of an I don't know answer.
All right. Thanks. Signet. Appreciate it.
Yep. Y'all have a good night. I'll see y'all bright and early for the morning briefing.
Later, man. Appreciate it.
Thanks, guys.